Hi everyone. With the Union Budget 2026 being round the corner and host of expectations lined up once again, there has been some significant developments in the form of apex court rulings on key tax matters that have essentially stirred the business world and deal-making activity at large. The Tiger Global ruling. While the underlying theme of the judgment revolves around substance over form, it essentially revisits long-standing and judicially established parameters of transaction structuring. In another critical judgment, the top court examined and ruled on the taxability of transactions involving receipt of shares under a court-approved scheme of amalgamation, giving rise to taxable business income in the hands of shareholders. In essence, both these rulings shall have significant impact on the transaction structuring and M&A activities at large going forward. Over the last few years, strong tax collections have coincided with rising transaction activity, particularly schemes of arrangements, PVC funding and outbound acquisitions. While the government's efforts are dedicated towards clarification and simplification of tax laws, what the market now demands is alignment of the same with commercial deal structures, especially in the areas where gaps have persisted. With this context, some of the areas where clarificatory provisions may be introduced are fast-track demergers and internal restructurings. The MCA had in September 25 made significant amendments under the Companies Compromise Arrangements and Amalgamation Rules 2016 and expanded the scope of fast-track mergers and demergers. The objective was to quicken the process of corporate reorganization without tribunal intervention. However, the tax laws have not been holistically aligned with the corporate law, as tax neutrality for the fast-track demergers is not yet recognized, since the income tax laws provides for tax neutrality conditions only in case of tribunal-governed schemes of demergers. As a result, legally approved fast-track demergers under the RD route continue to attract tax implications. This reluctance towards comprehensively supporting the fast-track reorganization route merits a reassessment. The holding period rationalization for slump sale transactions. While most capital assets now qualify as long-term, where holding period is greater than 12 or 24 months, business undertakings transferred by way of slump sale continue to require a longer holding period of more than 36 months. Slump sale remains a popular route of contemporary business restructuring, and hence a realignment of long-term holding period would restore consistency with the broader capital gains regime, reduce structuring-driven distortions, and enable more efficient movement of capital without diluting the underlying tax base. Widening the ambit of tax loss availability under amalgamations and mergers. The government may consider extending the benefit of carry forward and set off of accumulated tax losses under sections 72A to all companies without restricting it to entities operating under specific sectors. Business losses are a natural part of economic cycles and affect enterprises across industries, including companies in service sectors. A uniform provision would support genuine business restructuring and holistically encourage revival of stressed companies. Broader deferment of ESOP taxation. The Budget 2020 introduced ESOP tax deferment regime as a meaningful reform for limited subset of DPIIT recognized startups. For providing comprehensive relief, the regime may be expanded to include emerging sectors such as technology, renewable energy, biotechnology, and advanced manufacturing. This is particularly relevant where management rollovers are central to value alignment and retention strategies. Further, the deferral is capped at 48 months or earlier exit events, which significantly weakens its intent as liquidity events in growth stage companies typically occur at a much later stage. Taxability may hence be linked with actual monetization events.